Welcome back. As promised, we'll continue our monetary policy discussion, and we are now joined by Soumya Kanti Ghosh, Group Chief Economic Advisor, State Bank of India, Pranjul Bhandari, Chief India Economist at HSBC, and we also have Neeraj Gambhir, Group Executive and Head of Treasury Markets and Wholesale Banking Products at Axis Bank. Pranjul, gentlemen, thanks very much for being here. Mr. Neeraj Gambhir, starting with you and your takeaways, the markets went into this policy expecting perhaps a dovish pause. What we got was a slightly more hawkish statement. Growth retained at 6.5% and inflation seen inching above that 4% threshold starting next year.
Well, I think it was broadly in line with my expectations, at least. I was not expecting Reserve Bank to do anything in this policy, maintain the neutral stance that it has taken so far, starting from the previous policy, and be data dependent. I think that's exactly the messaging that we got. So in line with our expectations. Having said that, I think that it's very clear that now Reserve Bank is going to look at the incoming data, particularly on growth. We'll look at the impact of the changes that it has done so far, the front-loaded monetary policy easing that it has done so far, and see whether that's kind of transmitting into better impulse for the economy. And probably wait until December to see whether the full impact of monsoons, the easier monetary policy, the low rates, feeds into the system. And if the growth does not stack up, as we are all expecting, then only there is a possibility of Reserve Bank doing anything with regard to the rates.
Okay, all right. Pranjul, just wanted to come in on the growth argument. The RBI said that they're going to be very vigilant when it comes to incoming data. But are you factoring in anything in terms of, say, a base case scenario when it comes to tariffs?
Yeah, thank you very much. Just sort of a thought on this. A lot of people are calling this hawkish because the first half of FY27 growth number has been pegged at 6.6% and all of that. But I think the press conference that just happened, I think we got a clarification of what the governor is really saying. He's basically saying that he does not have sufficient data at this point of time to downgrade his GDP growth numbers the way he had for inflation. There was enough evidence for inflation, vegetable prices falling, but the same thing was not there for growth. My sense is, I actually don't see this policy as hawkish. I find this policy extremely realistic, given the data that was available with the RBI. In fact, if you read carefully, there is one statement which says that in May and June, some of the numbers seem to be more mixed than positive. And I think they will be looking at that very carefully. Some step down that we've seen in, for example, two-wheeler sales, GST growth, and all of that in May, was that a one-off because suddenly monsoons came quicker than expected, it impacted and hampered activity, or that's a new step down? And if and when the RBI gets the evidence that this is a new step down, then it can completely change its stance in October, in the sense it can bring down its growth forecast for the year and actually even deliver a cut. So from that perspective, given the data they have right now, I think they have made a very realistic policy statement. And of course, we don't even know where the tariff rates are going to go. So this has, in a way, been a placeholder monetary policy until more data is available.
Yeah, absolutely. We'll get the Q1 GDP print at the end of the month. And of course, we're yet to see the final outcome of those trade negotiations between the US and India. But Mr. Soumya Kanti Ghosh, you went into this policy expecting a 25 basis point rate cut, front-loaded rate cut. That has not happened. When do you expect the next action from RBI?
Yeah, thank you, Ritu. I think the policy actually was a very close call in terms of whether to maintain a pause or a rate cut. I think the MPC has gone ahead with a pause. As of now, if you look at the policy statement, I think the August could have been the best option for a rate cut because in October, the first quarter GDP numbers are likely to be strong for whatever reasons. I mean, it could be a technical, statistical artifact. But as there has been some mention of a mixed impact in the first quarter in terms of some indicators. And given the fact that, so basically, I think October rate cut would likely to be difficult. December also looks to be difficult because if it is not in October, then I think by that point of time, I think most of the data would have come. And in the second quarter GDP numbers are any projections, the numbers are unlikely to dip significantly further as per the RBI projections. So from that point of view, when you are in a rate easing cycle, there is unlikely to be a significant gap between one policy decision to another policy decision. So if October is not a policy decision, December looks a little difficult. And given the RBI projection that the next year, the first quarter number could be at 4.9%. And if that forecast remains, I think even though our forecasts are significantly lower than what the RBI forecast, even for the next year, first quarter and the second quarter calendar year. So from that point of view, I believe that possibility, if I go by the data which has been given in this policy, the further bar for any rate cut looks little difficult.
But are you saying we've seen the end of the easing cycle for this cycle? No more rate cuts if the cut doesn't come, later this year?
Yeah, I think so, because I think there is no point in going for a rate cut, maybe even though the numbers could actually surprise on the downside. The 4.9% projection could actually be a little lower because we are running around 30 to 40 basis points lower than that. And there is also the possibility of a new CPI base being introduced. So that could actually pull down the base even further. So as like that, there could be another 50 to 60 point downside estimates to whatever has been projected next year. But that's a technical issue. So if I go by this pause, I think the further bar for any rate cut looks difficult as of today, because I mean the point which I wanted to emphasize that the gap between the June policy and the other policy cut cannot be at least a year or so. So as of now, I think a rate cut beyond 5.5% looks difficult if I go by the policy statement and the data presented.
Okay. Neeraj, have you managed to chart what the trajectory could look like going forward in terms of the rate cuts?
So, as I said earlier, also in response to the previous policy, that to me, it looks like that the bar for a further rate cut is very, very high. And I think it will be largely conditional upon GDP growth not stacking up in terms of the expectations. And that is a big question mark. I think our forecast still continues to be of 6.5%, broadly in line with what Reserve Bank has said. There could be a little bit of a downside, but given the fact that you have negative WPI inflation, that kind of brings in a little bit of statistic upside to the GDP numbers. Having said that, I think even if there is one more 25 basis point rate cut, it's not going to materially change things. So I think broadly, whatever is expected in terms of rate cuts is by and large being delivered. Now it's a question of these rate cuts getting transmitted into the real economy, and we've seen a very fast transmission that has happened in this cycle. We've seen already savings bank rates being cut, deposit rates being cut. There could be potentially some more downside to the retail deposit rates, but that's again a function of the credit demand in the system in the months to come.
Neeraj, what is your terminal rate? And that question to everyone, starting with you, Neeraj. Where do you see this rate ending in the current cycle?
I think potentially 5.25%, but I will make it very, very conditional upon growth.
All right. And Pranjul, what is your number? And, when do you really see RBI acting next? Or as Soumya Kanti was saying, perhaps we've already seen the end of this easing cycle. And, if RBI doesn't move by the end of December, that window may also shut.
Well, I don't think the bar is very high for another cut at this point of time. I think we can see it as early as October. And the reason I say that is, we are looking at only today's data now. As soon as a little more data is available for the next few months, it could be clear that, growth is a lot more weaker than we are thinking at this point of time when we are looking backwards to the, first 4-5 months of the year. Also, my view is that we got the first quarter of FY27 inflation number, their forecast of 4.9%. But in further meetings, they'll unveil their forecast for the second quarter and the third quarter of FY27 inflation. And I think that will start going down from 4.9 to 4. Base effects is a very funny thing. It can either really lower or really increase your inflation prints, but over time, it also normalizes your prints. So I think in a few months from now, we will come to realize that 1 year ahead inflation forecast of RBI is not as high as 4.9, it's closer to 4. And then at that point, if they think that growth is lower than potential, then I think a rate cut can come. So I don't think the bar is very high for another rate cut, but I do think that we've seen most of the easing and that's behind us. If we want to really push up growth a lot more, we can't keep cutting. I think we can cut once, maximum 2 times. Eventually, the baton has to be handed to reforms. We just need more reforms to happen for raising our structural growth.
But Pranjul, what is your CPI number for this year? 3.1 is what RBI has gone with, and thereafter?
So for this year, our inflation forecast is 3. For next year, it's 5. But in periods when there are such difficult base effects to deal with, we just like to take an average, and our average here is 4%. And I think that's the underlying sort of inflation in the system. It's at 4%. So if growth disappoints, then you have a little bit of space to cut rates and drive rates lower than neutral.
Okay. But Pranjul, if you had to narrow down on the reforms that you were talking about, what are the top 3 that we could probably, that you think would be urgent and necessary at this point in time to fuel growth?
Okay, a good one. Look, I would say, I think we started the year with some very good trade reforms. We were cutting tariffs on intermediate inputs. We were getting a lot more open to FDI inflows, particularly in mid-tech sectors, even a little bit from China, perhaps for areas like textiles and footwear. We were going ahead, forging a lot of trade pacts faster than we've done in the past. So I'm hoping all of that continues. And I hope, with the US, we finally come to a settlement sooner rather than later. There is a domestic side to this as well. I think our southern line states have done a great job in high-tech manufacturing and exports. It's time for our northern line states to actually do manufacturing and exports of textiles, footwear, for which I think there are global opportunities. So any state-led deregulation that's going on or state capex that is rising, I think all of that are important structural reforms. I think that are happening, but we just really need to be deeper and faster.
Okay. Well, Neeraj, I also wanted to point out that we are also working in a very uncertain environment when it comes to the currency and the rupee. So how do you think that's probably going to play out in the coming meets, in the coming RBI meets in October as well as December?
I think there is some depreciation pressure on the currency as we've seen recently. Rupee has depreciated approximately 2% since July. I would expect that if we don't have a meaningful trade deal with the US, there will be some overhang of that on the currency. We could potentially, move another 1.5% in the next few months. But in general, there will be potentially more pressure on currency to depreciate than appreciate.
Well, Mrs. Soumya Kanti Ghosh, just wanted to come back on the GDP numbers, the confidence which RBI showed, keeping it at 6.5%, although they say they're awaiting, more information on how these tariff tensions pan out, how the first quarter print looks like. What did you make of that 6.5% and 6.6% number that we've got, and what is your own in-house view?
See, our in-house estimates are a little lower than the RBI because we had factored in the tariff uncertainty earlier, so we are holding it at 6.3%. But having said that, let us drill down the possibilities of a rate cut maybe in October or even in December. In October, when the RBI will announce the next policy, we'll have the July inflation numbers and the August inflation numbers. July inflation numbers are trending closer to around 1.1, or it could even go lower. And August actually could be around 2%. In November, but the GDP number for the first quarter possibly is likely to be strong enough and will be closer to 7%. So when the policy is announced in October, the prospects of a weaker GDP growth for whatever reasons is actually not on the table. Now in December, whenever the policy is also announced, there will be 2 more numbers, the inflation numbers. I think for September, October will be released. The inflation numbers will continue to be benign. October will see it going again below 2%, and September could be around 2.5% and so. So all through, well, the inflation numbers will continue to be significantly benign, but the second quarter GDP number is also due on the 30th of November, and the policy is actually announced in the first week of December. That, as per the RBI projection, is also holding up at 6.6%. So with a GDP number, for whatever reasons, is holding up at 7% or 6.6% for the first half, I see little reason, even though the inflation numbers will continue to significantly undershoot, to cut in October or in December. So by that logic, I think August possibly could have been the best occasion, but now the further bar for any rate cut looks a little unlikely as of today.
Okay, so the window, according to you, Mr. Ghosh, was August is when the RBI could have made that move in terms of a rate cut. But you did mention that your GDP estimate does factor in a little bit of the tariff, what we could expect in terms of tariffs. So what are you factoring in when it comes to tariffs, and what is the incremental expectation or impact on GDP that you factored in right now?
See, I think the tariff is actually largely a story of uncertainty. As for the tweets which are happening in the evening every day, Mostly tweets are, as of now, are actually pointing to a downside of the GDP numbers. We have factored in around 20 to 30 basis point downside of the GDP numbers. But it is equally possible that India and US could actually clinch a trade deal. The way things have moved with China and other countries, I think if India can clinch a trade deal, maybe in the next month or so, maybe even in August when the US delegation visits, then who knows, there could be an upside to the GDP numbers given the entire uncertainty scenario is stacked up. But as of now, given the uncertainty on the tariff front and given that India actually has a significant amount of trade surplus with the US, my sense is that there will be some impact on the GDP. And our estimates last time shows that the estimate around 20 basis points. The good thing is that we had already factored it and front-loaded it. That's why our estimates are 20 basis points lower than the GDP RBI at 6.5%.
Who knows? Rightly said, Mr. Soumya Kanti Ghosh, and we will see how those evolve. But Mr. Neeraj Gambhir, quickly, where do you see the 10-year in the near term? And any thoughts on what the governor gave us a hint of what the new liquidity framework would look like? He said the recommendation is to continue with the overnight weighted average call rate as the operating target for the monetary policy. What sort of impact do you think this would have?
So on the bond market, I think the bond market is now kind of hovering around 635 to 640 level. I don't see a meaningful upside from these levels because there is possibly maybe one rate cut or maybe not even that. Going into the second half, the bond market has to deal with slightly difficult supply-demand situation. The long bond supply is actually quite heavy and demand is a little bit on the wane. So we'll have to see how that demand-supply situation plays out as far as the longer end of the curve is concerned, which is about 15 years and above. But at the shorter end of the curve, I think the rates will stay well anchored as long as the overnight stays close to 5.5% and liquidity in the system stays in the surplus mode, which it is right now. As far as liquidity framework is concerned, I think it's a bit technical in nature in the sense that Reserve Bank has been using a weighted average call money rate, whereas the transaction volume in the call money market are actually very limited. So there was a suggestion to move from weighted average call rate to something more linked to the volumes in the market, which is the TREPS market. We'll have to see eventually where RBI settles with that. It's a bit technical. I don't expect this to have a significant impact on the bond market yields.
All right. Mr. Soumya Kanti Ghosh, Pranjul Bhandari, Neeraj Gambhir, all of you, thank you very much for staying with us and helping us analyze this policy. On that note, we'll thank you and take a short break, but don't go anywhere. We're back in just a moment with more news and updates.